So given the recent fluctuation of share price around Alibaba as a company, there is this heightened interest amongst the community where viewers are essentially trying to solicit advice from different sources, whether you're a bull or a bear of Alibaba or Tencent or any of these Chinese stocks. I think people are just interested to know what are the different price targets put onto these different stocks. So for myself, simply put, just a disclaimer, I'm an Alibaba bull, if you haven't realized already. But that said, I think the model that I'm going to present in this video specifically, it's going to be on the more conservative side because I don't want to just plug in numbers from thin air and to assume that Alibaba is going to revive its growth rate to 20, 30 or 40% and just give you a humongous number and just sales talk you guys into buying Alibaba stock. No, that's not my intention of this video. I think I just wanted to put forth the different probabilities of how things would play out for Alibaba. You can essentially police many of my assumptions that are baked into the model itself. And if you're interested, you can even build a model of your own. But that's it. For me to even have a position in Alibaba, and such a huge one, means that I think that it's severely undervalued. And you can know why later when I pull out my Excel. So just a quick note, quick disclaimer, this is not any buy or sell recommendation. Doesn't mean that a stock is cheap or security is cheap means that it's a buy. No, it's not. Valuation is just one part of doing the homework. You still have to understand the business. You have to understand how sticky the revenue is. How does it pass down to bottom line? Whether they're able to fend off competition, etc., etc., etc. Introducing today's sponsor, Skillshare. So Skillshare is an online learning community with thousands and thousands of online classes for all sorts of topics. They have a wide range of topics from personal finance to productivity and even how to start your very own YouTube channel. So like investing, I think the biggest asset in your life is not your stock portfolio or even your property. It's yourself. Like everyone else, when we are at home, we always have that inertia and procrastination inevitably kicks in. So right now, I'm taking a class from Thomas Frank with regards to productivity and how to build habits that last. As Skillshare is sponsoring this video, the first 1,000 people to use the link down in the description below will get a 1-month free trial of Skillshare Premium membership. So now, just to quickly bring you through my own model, I think for long-time viewers, this is probably not the first time that you saw this model before. So essentially, I pulled out all the figures from all the way back from financial year 2015. So this is essentially 7 years worth of data. So some of you might be asking why is there 2022. So Alibaba is a very unique financial year. They actually end every single financial year on March. So this time around, it's no different. So they call it FY 2022, even though it's 9 months in 2021 and just 3 months in 2022. But that's that. So this Excel is actually done up, I think a few months back, actually a few quarters back. And you can see that there is this grayed out portion because essentially I was trying to model out from 2021. And because a few quarters have passed, we have already entered a financial year. That's why I included this line, which is what Alibaba did last year. Or I should say the start of this year and 9 months of last year. So you can see that Alibaba was actually a crazy growth company. By crazy, I'm not undermining the feat and the achievement that Alibaba has achieved thus far, by the way. Look at the growth rates from 2015 all the way through 2021. 45%, 32%, 50%, 50%, 40%. And last year, even though we were at the peak or at the height of the crackdown, everybody said that, oh, Chinese tech, they're going to cease to exist. The government is no longer allowing them to function properly. And they managed to grow revenue on a year-on-year basis by 19%. 19%. But of course, yes, at the later part of this year, we can understand that based on street estimates and analyst estimates, Alibaba is actually purported to only grow around 2 to 3% for this financial year into 2023. So that said, I think it's up for you to make the judgment and decision on whether, number one, is Alibaba able to normalize back their growth? Number two, do you think this headwind or do you think this weakness in growth, is it a sustainable one or is it a short-term problem? And I think last but not least, in terms of understanding Alibaba's business itself, do you think that they are able to maintain margins? Because on the right side, you can see that at least for EBITDA margins itself, it has been on a steady declining trend from 36% until 16% just last year. So you have to make the assessment on your own. So I think just before I bring you through the model itself, I think there are 3 core criteria that I look into any single model. And I know that, at least in the finance space, there is a huge range and a huge spectrum of how people like to model out many of these securities. So some of them can be as complicated as trying to model out every single line item in the balance sheet, in the cash flow, in the different business segments. And for those of you who know, Alibaba has a crazy ton of business segments because as far as skeptics are concerned, Alibaba is still a conglomerate. It's a hundreds of billions of dollars worth of enterprise value. So they have many different business arms and business segments that are growing at different rates. So you were to ask me, am I able to model out the different line items of every single business segments? Yeah, sure. It's gonna be a very tedious and a very arduous journey, but I'm sure if you put in the time, you crunch the numbers, you are able to do it. But that's it. Do I really think that there is a need to do it? Personally, I don't. So in terms of how I look into valuations of company, I actually took the lesson from Prof. Damodaran. So he's actually a business prof in NYU. And he essentially has the nickname of Dean of Valuation because he teaches valuation on a very high level, I think in both undergrad and even on the MBA level. There are only 3 specific criteria that you have to look into. Firstly, it's the revenue growth. Top line revenue, how are they going to perform? Are they going to continue growing modestly? Is it a hyper growth company? Or is it even in a declining industry where revenue is expected to slowly just fade away? Number 2, in terms of margins, are they able to hold very high levels of margins because of brand name, because of lack of substitutes, etc.? And last but not least, the level of capex, which is the level of reinvestment the company needs to put back into the business, whether is it maintenance capex or whether is it expansion capex. So these are the 3 key criteria that he look into. And similarly, I kind of morphed these 3 criteria into how I look into the different businesses and how I analyze them. So you can see that my model is extremely clean, extremely simple. I don't think that you need to be very complex in this entire endeavor because I would rather be roughly right than precisely wrong. I think that's a quote from Munger or Buffett. Now, I think one core part of valuation is also the story. So the story that you would like to tell the viewers or to tell yourself that is supposed to be built into the model itself. So to give you an example, if let's say that you think the Chinese economic miracle is here to stay and these are short-term headwinds, maybe you'll be bumping up the growth rates of Alibaba from year 3 onwards to maybe a highs of 15%, 20%, because Alibaba has achieved a certain level of critical mass where if the Chinese economy is going to grow by a disproportionate amount, Alibaba is able to enjoy those sort of growth as well. But this time around, I think in my conservative case, in my bear case, in my bull case, I'll explain to you my thought process on why I use certain figures. So that's the first part in terms of growth. The second part, in terms of margins, you have to also tell yourself a story in why you think Alibaba is able to maintain 20%, or why do you think, for those of you who are more aggressive, you can put 30% instead. I don't know, maybe they are able to continue capitalizing on their e-commerce business and their high take rate business. I don't know. So that's the story you have to tell yourself. And last but not least, the most important figure here, which is the ending valuation multiple, which is denoted in this case over here, or this box over here, which is the long-term market multiple. So just to walk you through, if you to see, Alibaba used to be an extremely high growth company, growing at least 40 to 50% easily. So just the last year, they experienced a huge headwind. I think it went from 40 odd percent down to 19%. And this year, many analysts or street estimates have Alibaba growth capped at around 2 to 3%. I have Alibaba at 3% for this year, and then 12.5% in year number 3, 10% and 10% in year number 4 and 5. So you can see that the average growth rate for Alibaba projecting outwards for the next 4 years is on an average of around 10.9%. So I think you make the assessment on whether you think I'm being conservative or whether you think I'm being aggressive in many of these revenue growth estimates. Personally, I think it's already on the more conservative side. But some of you might ask me, hey, Chiking, where do you get all these numbers from? Truth be told, these are street estimates. So I just essentially pulled the aggregation of the different analysts from the different banks, most of your bulge bracket like your JP Morgan, Goldman Sachs. Many of them do follow these e-commerce companies or many of these Chinese big tech companies with a very close eye. So these is their projections moving forward. And now, moving on to the second part, which is trying to determine the EBITDA margin. So you don't have to pay very close attention to the middle EBITDA margin. I think what we are more concerned about is the ending EBITDA margin, which is in year 5. And in this case, it's year 2026. So why so? Because this is essentially a back of the envelope valuation model where we just want to take the EBITDA margin at year 5 and then apply a market multiple, which is whatever times that you put here, and then you try to calculate the enterprise value of Alibaba in year 5. And then by doing so, you just less the debt and add back the cash, so you get the market cap of Alibaba in year 2026, and thereafter just divide by the number of outstanding shares in year number 5, which is year 2026. So in this case, I think just to walk you through on why I think 20%, or at least what's the story that I tell myself when I put in a 20% EBITDA margin, I know that Alibaba was a very high margin business. They were engaged in just pure e-commerce. So even though pure e-commerce still makes up a bulk of Alibaba's business today, but you can see that they are slowly expanding into other areas, like local consumer services, into groceries, into cloud computing, and those are clearly a much lesser EBITDA margin. They enjoy much lesser EBITDA margin because of the nature of the business and the nature of the industry. So now, if you're to put forth the argument that, hey, Alibaba is going to inflate back their EBITDA margin to 30% or in the north of 35%, personally, I don't believe that it will happen. But that said, if you to ask me whether the 2022 EBITDA margin at 16% or 17% is reasonable, I don't think so too. Because over the last year, you can see that based on the management report through the conference call, you can see that they have been saying that, oh, they're constantly expanding many of their business arms, they're trying to penetrate into new industries. And whenever you are at the start of that growth curve, you tend to spend a lot more, and many of these business segments are profit losing. So they actually don't kick back any sort of margins, which is why there's this temporary pressure on EBITDA margins for Alibaba as a group. But that's it. I'm presuming here, or at least my prediction here in my model is that within the next 4 years, Alibaba is able to normalize their margins. Sure, you can disagree with me on this. You can put 18%, you can put 15%. I think it's totally up to you because that's why it's your own model, not mine. Now, if to go on to the third most important number, which is the long-term market multiple. So I've also stated the EV/EBITDA multiple for Alibaba over the last 7 years. So you can see that over the last 7 years, they've been trading at a relatively high multiple, even in the mid-40s and sometimes even the high 20s. But that said, I think in the last 1 year or so, valuation essentially collapsed because there was a lot of headwind, a slowing down Chinese economy, and you add in geopolitics, and it's basically the recipe for disaster. So you can of course argue that, hey, because of these geopolitical concerns, valuation multiples of many of these tech companies or Chinese companies in general are going to take a permanent impairment or a permanent hit. So they're going to trade at a very low valuation for a very, very long time. I think it's perfectly up to you to decide on that. But to me, I don't think so. I think many of these concerns about VIE, geopolitics, etc., these has been a long-awaited or long-abetted concern since 2015. I don't think there's a very stark difference. Of course, tensions are rising a lot higher in recent times, but it doesn't mean that Alibaba is going to trade at a 10 times EV/EBITDA. That's at least not what I believe. So in my base case, I actually put their long-term market multiple to be 18 times. You can decide whether this is fair or not. I think it's up to you. So this is my model, so I get to dictate what price multiple I want to use. And last but not least, you have to take into account the diluted shares in year number 5, and in this case 2026. So in my own model, I'm assuming that they have a net buyback of 1% every year. And take note, it's a net buyback. So I do understand that many of these tech companies actually do share-based compensation to their management team and to the different employees to essentially try to motivate them to be aligned with shareholders' interests. So I'm not discounting that fact, but that said, I think because of the recent share buyback program that they've announced, essentially, based on my own rough calculations, they are supposed to at least provide a 2-point-something% buyback yield for shareholders in the upcoming 2 to 3 years. And this time around, I'm just netting the share-based compensation. So I'm just assuming that they only buy back a net of 1% of outstanding shares every single year. So I project this outwards for 4 years, and then I get a fully diluted share of around 2.5 million, if I'm not wrong. So in this case, my projection for the stock price at 2026 is actually $274 USD. So all these numbers are denominated in USD. I know there are concerns of FX and how the USD is strengthening, but personally, I don't think the USD is going to strengthen perpetually. On the flip side, I don't think the renminbi is going to devalue perpetually as well. So I'm just going to hold a constant rate here and just make my assumptions and my modeling out into 5 years. because I would believe that many of these FX conversion risks would kind of normalize in 4 years' time. So this actually brings a CAGR of around 22 or 23%. So someone might ask me, hey, Chigeng, Alibaba is not trading at $120. Why are you putting the stock price at 120? So just so you know, my own average price of Alibaba is at 120. So I don't really care what the market is trading at today. And for all I care, Alibaba can be trading at $50 today. It doesn't matter, because if I don't have a position, or if I'm not adding to my Alibaba position, even though it's at $50, it doesn't matter. So just to draw the stark difference, when Alibaba was trading at a 52-week low at around $58, if I were to input $58, based on my baseline base case assumption for Alibaba, within the next 4 years, your CAGR is actually expected to be around 47.51%. So looking back, it does indeed look pretty crazy when Alibaba was trading at that valuation. Now, moving on to both the bear and bull case, I don't think I'm going to explain too much here. Similarly, you just have to adjust the revenue growth, the long-term market multiple, and your outstanding shares. I think this is the three main factor input that I put into when I try to evaluate what Alibaba share price would be. So based on a 9.2% average growth rate for the next 4 years, and a 15 times market multiple with zero dilution, so assuming that there is no buybacks, and assuming that they don't issue more shares, so let's just assume that the 2% yield that they give out in the following 2 years will be negated by the 2% in terms of share-based compensation. At a $120 current average price, the CAGR is around 12%. And in the bull case, it's even crazier. It's at 34.61%, assuming a 12.9% average growth rate and a 22% margin. So you decide whether these assumptions are feasible or whether is it conservative or not. So which is why a valuation model is a lot more art than science. There isn't really a correct answer per se. Only time will tell who's correct. So I do hope that you enjoyed this discussion. Please remember to help smash the like button as well. And I'll see you in the next video. But more importantly, I will see you on the moon. Goodbye.